Um, I could have sworn I heard a sigh. Like I needed, like someone wanted to expand on that. Um, but you've got to be able to take proactive charge on that. Now, so regardless of that, I want to first do a quick shout out because I have another mentor of mine, and I was doing some posts in my Facebook group regarding unauthorized practice of law. And what's interesting about that, now that has something to do with living trusts, but it shared. I got a legal, was it legal opinion? Not just opinion. Actually, it was a final court decision, Florida Supreme Court decision regarding duty of loyalty. I'm going to share my screen on this real quick because I want to actually read this out. So here it is. And by the way, this is basically saying that an insurance agent is not covered for doing legal activities like drafting a will or a trust, or even offering software that drafts a will or a trust. So, I shared my screen, but it did not go on the screen. Here we go. See, eventually I'll remember how to do all that stuff in real time. So here's what the Florida Supreme Court said. This was in 1993. It says the question posed by a petitioner also presents a potential conflict of interest for a lawyer employed by a corporation or other entity involved in the sale of living trusts. Loyalty is an essential element in the lawyer's relationship to a client. If in advising a client about the disposition of property after death, the lawyer must first determine whether a living trust is appropriate for that client. If so, the lawyer must then ensure that the living trust meets the client's needs. If the lawyer is employed by a corporation selling the living trust rather than by the client, then the lawyer's duty of loyalty to the client could be considered compromised. I added the word considered. Lawyer shall not represent a client if the lawyer's exercise of independent professional judgment in the representation of that client may be materially limited by the lawyer's responsibilities to another client or to a third party or third person. Lawyers shall not accept compensation for representing a client from one other than the client unless, one, the client consents. There is no interference with the lawyer's independence of professional judgment or client-lawyer relationship, and information relating to representation is protected. In light of this duty of loyalty to the client, a lawyer who assembles, reviews, executes, and funds a living trust document should be independent counsel paid by the client representing the client's interests alone. Now, we can easily take that, and how do we apply that as a fiduciary? A fiduciary can only, other than being able to disclose otherwise, only offer those products and services which the client has accepted, and that compensation coming from the client. But the insurance industry is saying what? We get to earn a commission. We want to earn a commission. Well, the commission is by definition a third-party compensation. And so what the fiduciary lobby is saying is that should not be allowed, because that's going to influence your judgment, because you're getting outside. By the way, and they don't say how much is a problem, right? You could be getting, it's funny, you could be getting trips, you could be getting obviously commission company, you could be getting merch, using the common term. If I had a tumbler from another company, I think I'd have to disclose that Athene gave me a mug. That would have to be disclosed, saying they gave me merch. I mean, to me, it's kind of stupid, but that's what the purest definition of that duty of loyalty means. You have to disclose all of it. And that's where they're putting the compensation ahead of outcomes that are potential for the client. I prefer to look at the actual outcome. That's what makes financial advice different, because we're not preparing wills and trusts. We are creating economic tools, financial instruments, and the combination of which, or the exclusive use of one, whatever it's going to be, to how it's going to greatly impact the client overall. And there isn't a one size fits all. It's what is within my professional judgment, and however I decide to get paid is how I'm going to serve that client. Okay, I just went on a rampage on that one. What are your guys' thoughts so far, so I can take a quick look at my notes here?
Well, I mean, it's just a, the way this has evolved over the last, X amount of years with the with the whole fiduciary rule thing. If you go back, if you've been in the industry, for any extent of time, look how this is just morphed into so much more than what it's really about over the last, I don't know. Let's just throw a number out there. Let's say, the last
8 years or so.
7 to 8 years. Yeah. I mean, something that kind of comes to mind with how this has evolved into so much more than what it should be is look at your suitability forms and look at different things that have had to be, restructured and to reformatted to for compliance reasons with every carrier out there from an insurance perspective or an annuity carrier or whatever to make sure that they're covering what they feel like are their proper basis for legal reasons. And it's just it's cost the industry an enormous amount of money, of dollars, to fight things that should really just be a common denominator among all those that are quote unquote fiduciaries, live by the FINRA rules, or those that are governed by insurance laws and different things. It's just it's the very reason why we kind of advocate for what we do, which is we don't really make recommendations to anyone. We just make you aware of the situation that you have and give you your options, and you're ultimately, you the client, you've got to make that decision. So if that's in your best interest and you like a particular way of a product maybe fits your need, then aren't you being a fiduciary? Don't you have their best interest in mind? I mean, it's just I kind of probably sound like a little bit of a repeat and a broken record with some of it, but it's just gotten way out of hand with how many people have got their hands, so to speak, in the cookie jar, wanting to say that you can't say this and that you can say this, but you got to have this license, or you've got to have you've got to be with this broker dealer, or whatever the case is to speak to it. What happened to the morals and the values of just telling the truth?
I don't know what happened, other than a wedge has been created to basically say I'm better than you, and I can prove it because the law makes me. By the way, I'm going to say this: if the law has to force you to be a decent human being, you suck as a human being.
Exactly.
Fair enough, bar none. That's it. I don't care. You suck as a human being if you need the law to tell you so.
So I have the Medicare background here, so I'm going to relate this a little bit to Medicare. Maybe this will help some people. So with Medicare, you have CMS, the Centers for Medicare and Medicaid Services. And every year, they change these rules about how you can do enrollments and the certifications you need and the this and the that. And, in theory, it's supposed to be in favor of the senior or the retiree. But in reality, just because you're doing a certain certification, or they're making the enrollment so that you have to have this cool down period or this or that, it's not necessarily of any benefit to the client. You're still going to have people that find a way around the rules. You're still going to have people that falsify forms. You're still going to, no matter what you do, you're still going to have issues. So, and they've gotten so much more strict and regulated with all of this stuff over the last decade that I've been doing Medicare, that it really hasn't helped the agent or the retiree. If anything, it's hurt both, because now you have a lot more steps for the retiree to go through, and you have a lot more steps for the agent to go through. So in one sense, regulation and oversight can be a good thing, but when you start to, nitpick every little thing, it starts to really drag down the whole process and hurt both the advisor or the agent and the consumer as well. Maybe that makes sense. Maybe that helps. I don't know.
It's another perspective. And the thing is that government regulation does not always turn out the way that we want it to. And it certainly doesn't help our efficiency, that's for sure.
Right.
There's a lot more to it. So I want to go real quick about the 4 levels of fiduciary that Michael Kitces wrote about years ago. And he said the first level of fiduciary is having a Series 65. Now, what does that mean? What that means is not that someone who holds a Series 65 is a fiduciary in everything they do. It means that if they're in that role and you have signed an engagement agreement, you probably have an investment policy statement with that person, you're going to be paying a fee based on your assets under management or project management or whatever it is you're doing. They have a duty to you. And that's what the Series 65 represents. Now, you could also be working with a broker who still sells mutual funds and variable annuities and whatever else. And just because they have a 65 doesn't mean everything they do is under the 65 rules. And they keep talking about it. I'm not that smart. I just happen to know that the law says that if you are acting as a broker, you've got one standard, which is the suitability standard. If you're acting as an agent or as an advisor, then you have another standard. I don't care. I've got one standard. Can I make you better off? That's the only standard that I have in mind. I don't nitpick. I'm not that smart trying to bounce. Hey, can I rip you off over here versus putting your best interest over here? No, I can't think that way. I've got one standard of things, which is, can I help the client be better off? The second standard is being a CFP holder, and as a CFP holder, everything you do is under a CFP standard. They have made a lot of press releases, a lot of things as they've increased their standard, especially if the CFP is considered, if they consider themselves fee only. Now, when you consider yourself fee only, there's a whole nother standard on that because you can't receive a commission of any kind. I've actually seen CFP either disciplined or revoked because they receive real estate commissions. And this was years ago. I remember reading this article quite some time ago. I'm like, that has nothing to do with financial advice if you're selling real estate on the side. But apparently, they're trying to include everything. And by the CFP board is trying to make a name for themselves by saying, we're going to regulate all aspects of financial planning, including everything that our CFP holders do. That's why they do this kind of thing. Now, in that, I also put in parentheses the CFF, which is a Certified Financial Fiduciary designation. It was launched about 6 years ago. I hope that anybody that has the CFF understands that you're portraying yourself to the public as a certified financial fiduciary, which means everything we're talking about, you better be disclosing everything. Because if you get into a complaint situation, the attorney will rake you over the coals based on how you promote yourself to the public. So enough on that part. But the third one, the DOL fiduciary, we're going to be talking about that even more. But you've got to have. By the way, that law has not become enacted currently. It's being stayed in a Texas district court or Texas Supreme, whatever it is. The fourth standard is self-proclaimed. If you say you're a fiduciary, you're going to be held to that standard, particularly in a complaint situation. So here's the thing is, and because I've given private briefings on this topic and such, and the thing is that why would I voluntarily increase my professional risks when I'm literally in the business of risk management? Why would I voluntarily increase that for myself when I don't have to legally? Now, maybe one day it's going to get passed. I'm going to have to. I already have a plan for that. I'll talk about that later. But the other thing is, when is a fiduciary, like someone has a 65 or anything, when are they your fiduciary? And they're only your fiduciary once they sign an engagement agreement. Both parties understand the scope of their mutual responsibilities to each other, and there's a payment of fees, and that is called consideration. The consideration is where the duty of loyalty needs to lie, is who is the source of that consideration. So you might say, well, my advisor, he's a fiduciary. Did you pay a fee? How is the fee being calculated? How are you being charged for that? Fiduciaries are not free. And by the way, commissions aren't necessarily free either, but is that a material disclosure? See, I'm going to be talking in circles here. Because in fact, why are we against that? My biggest issue with the fiduciary standard is commission disclosure. With insurance products, here's the thing that commission disclosure, it's not a cost to the client. That's the biggest thing. Was it 6 months ago or so? The White House came out with a thing that said we're going to end junk fees or trying to limit junk fees. But with annuities and life insurance, there's no additional cost that's there. Our compensation comes from the insurance company. It's part of their marketing budget. They recapture that over a period of time. It's called a validation period. This is why during the first few years of a contract, you don't have full access to everything in it. whether it's an annuity, you might have surrender charges and a surrender charge schedule that declines, let's say, over 10 years. If it's life insurance, you have increasing available cash values, because if you cancel too soon, the insurance company gets to recap some of those costs that they paid out. But it's not a direct cost. Now, how can I also say that? Is that if you contacted the insurance company directly, you said, I don't want a broker, I don't want an agent, I want to get my contract directly from the company, I don't want to pay commissions. Guess what? You're going to get the exact same product, the exact same design, assuming you get the right kind of people to do the work for you. But you're going to get the exact same everything. The only difference is the insurance company got to keep it. You don't have an agent. It's the only, because these are state regulated products. Everything is, there's no additional line item for the commissions. It's already all built in. It is what it is. If it was an additional cost, and we talked about mutual funds a few weeks ago, like A-shares. A-shares have a direct cost that lowers the investment contribution in there. That needs to be disclosed. But with insurance, there is no cost like that. Therefore, to me, it is not a material consideration that requires disclosure. It doesn't make an impact. What does need to be disclosed? You need to disclose what the material fees are. So if you have an annuity, are you paying extra for a lifetime income benefit rider or any other additional optional riders? If it's a variable annuity, you got all kinds of other fees that just are all bundled in. For life insurance, it is with whatever is within the contract, however the contract is illustrated. So you need to know the risks. And usually with fixed insurance, it's not necessarily market risk, but it's performance risk, especially if it's an index type of a product. What is the potential return, at least according to the current year, because those things can vary depending on indexes and interest rates and such. What is the cost? Again, like, is there something coming out of your investment capital that is an actual cost? What are the terms and conditions? What are the taxable implications? All of that is a factor. None of that really factors in commission. My commission could be $1, my commission could be $1 million. It really doesn't matter as long as the contract properties and the whole thing, how is it implemented in someone's complete financial picture? Is it going to make the client materially better off based on the contract properties, whatever it is? To me, that's what's most important. So why am I afraid of commission disclosure? In the pension markets, commission disclosure has been that way since forever. You have to disclose your commissions. But in the pension market, and we're talking about corporate pensions, you're presenting to CEOs, CFOs, business owners, and that kind of thing. They're used to that. And they're also used to the fact that you're in business. You're here to make a profit. And the commission is the commission, whatever happens to be. But in the middle income market, if someone has been working for a long time, let's say 30, 40, 50 years, and they're finally retiring, and they've got, let's say, $500,000. Now, I don't mind using this as a hypothetical. These are real numbers. But if someone retires with $500,000, and I determine that, a fixed index annuity based on let's assume that the whole thing is suitable, and I can put the whole $500,000 in there. I could get 6% of that up front. How much is that? 6% of $500,000. That's $30,000. Now, let's think about advocating and thinking about the middle income market. They might think, gee, $30,000. It takes them maybe 6 months to earn that much. There's an element of jealousy that could come in. And then there's an element of, is this really my best interest? If they can make this much money, am I sure that this is what's right for me? And yet 6% is a very standardized commission. That's not out of reach. That's not impossible. It's a very standard commission. And yet I don't want to create unnecessary conflicts within the client to prevent them from moving forward as long as everything else fits. All right, you guys, I've been talking a lot. Come on, chime in here, guys.
Well, to your point right there that you kind of ended up with, I think if you do a good job with your client, and they bring up the fact of how do you get paid, that comes up more often than not. I mean, and you explain to the client the situation with the product that your recommendation is, or something that they feel like that's something that they would like to participate in and have a portion of their assets go toward. I don't have too many people that are against that. If they understand that the product that you're recommending is going to satisfy that need, and they're comfortable with that, then I'm kind of okay with as far as they want to take that conversation. But from the fiduciary side of it, you have so many, not every advisor, obviously. I mean, we don't want to, throw everyone into the same bucket, but you have so many of them out there that just feel like, because they're branded with that word, that th- they can only give that advice, and their fees and their charges are more relevant than what you're, if you're an insurance guy, or an insurance product that you're disclosing, it has more value to it. I don't see the difference there. I don't see how that one is really any different than the other. But at the same time, I just circle back to the client needing to understand what certain products do. And like you said, with annuities, for instance, I mean, so many of your middle market people, um, it's what Social Security is. Social Security is an annuity. I mean, it really is. I mean, you're getting a guaranteed payout at a particular rate, and 99% of the people that I sit in front of are going to gravitate toward that guaranteed side of things, instead of that up and down cycle of the market and the volatility that can only come from being invested, in products that are fee based, and that charge that an advisor gets a fee on, where your account goes up or down, he's going to make money. And the client's looking at it, like, hey, you're making money whether my account goes up or down, but I need it to at least do this. Can you guarantee that? And if they would spin that question back the other way, I think that they may have a different look. The client may have a different look at what they're actually already currently involved in, or maybe look to something that has a little bit more of a guarantee, especially for those people that are retiring tomorrow, for instance. I know that's sounds quick, but I'm just talking about those that are in that short time frame. If you're 20 years old, and you can afford to get into the market, so to speak, and ride some of those things out for the majority of your working years, that's a different argument. But for those that are looking for guarantees and stability, because of the way the market and the way the world is today, and inflation and different things, can you really afford to gamble with managed money if you've got $1 million, using that as your example? I mean, can you really afford to toss some of that out there, and roll the dice? Can you afford to do that?
Which goes back to the fact that fiduciaries put the method of compensation above the fact that that other products can have guaranteed results and guaranteed outcomes. So we're putting the outcomes ahead, as opposed to they're putting compensation, and they consider it a material conflict of interest if there's any additional compensation outside of the client. So they're putting the compensation horse before the cart of what are we going to actually do and guarantee for you. And of course, they can't usually use the word guarantee. They're prohibited from even using that word unless they really can guarantee.
Yeah, and it gets also into the fact that you know the guarantees that are out there, they the fee-based guys, they could do things differently. Those that choose to, they could do things a little differently within the product portfolio that they have to work with. But the thing that gets me on the fiduciary thing also is the fact that they're charging a fee on money that's not even theirs. I mean, they're making money on it goes back to being tied to the government, and having control, and who's really making the money? It's the institutions and things like that. It's just that's my biggest beef, I think, with everything. They charge a fee on money that is not the clients, and definitely not theirs.
Which means that they don't have an incentive to
Exactly.
talk about anything that could be a little bit more tax efficient. But if it lowers your investment balance, there's a conflict of interest there, because they would get less income against that reduced balance. And that's a big deal. And so so it sounds so good when they say, I'm on your side of the table. When you make money, we make money. Of course, when you lose money, we lose a little bit of money too, but at the same time, we're on your side of the table. There's other things that life insurance and annuities can do, both from a tax perspective and an efficiency of retirement income cash flow perspective, that managed money just cannot do. They cannot do it. Now, that doesn't mean you can't mix in managed money into some of these strategies. I'm not saying that at all. I'm just saying that to ignore the potential that life insurance and annuities can bring, I think, is a fiduciary violation, but it's not because of compensation. It's because of outcomes that can be generated. And what is our duty? We want the best outcomes that we can generate for the client. And guess what? Insurance companies will pay us very handsomely to find people who need those problems solved. And I want to keep letting them, because that's my job. Let me find the opportunities. Let me help solve these problems. And I want to get paid very well for doing it.
It reminds me of a situation in our group where we helped one of our advisors help one of their clients with a situation, and the client said, I hope you make the most money you've ever made on this. Why? Because he now had peace of mind, and he knew that what he was doing was the right fit for him, and he couldn't do anything better that would perform the way he wanted it to. He didn't care what the agent made. He hoped that the agent made a fortune. He wanted them to, because he understood the value of what he was getting.
Yes, that is the ultimate definition of a great client. When the client, now again, the client has to win first, right? We cannot do things at the expense or the cost of the client, where the client is going to lose and we win. If we look at the 7 habits of highly effective people, habit number 6, I think, is think win-win. And that's what you've got to do. You got to synergize. It's either synergize or think win-win, one of those two. Either way, those habits, those priorities should win in every interaction. But it should not necessarily mean that the client wins and I lose. I am not on the race to the bottom. I am not a nonprofit organization. I am here to do well for myself, but I'm not going to put my interests above a client's interest, which brings up, and I've got more talking points. And Alonso, I see your comments. I promise we're going to get to you, my friend. So I'm going to share my other screen, because every association worth joining in the industry has a code of ethics. So I'm going to start with this, because NAIFA, the National Association of Insurance and Financial Advisors, NAIFA members put the interest. Oh, I got to share. Just because I clicked, I got to remember to keep hitting that button. So NAIFA members, we put the interest of clients of their clients first. And there's a whole code of ethics here. And the whole thing is that we need to put the client first. Now, here's the next one, the American College. When you're a graduate of the American College, they have the professional pledge. I mentioned this on the podcast the other day. He hasn't published it yet. He has the RICP designation, Retirement Income Certified Professional. It's an offering from the American College. I quoted this poorly, but he didn't know that he signed it. Every designation holder has signed this. In all my professional relationships, I pledge myself to the following rule of ethical conduct. I shall, in light of all conditions surrounding those I serve, which I shall make every conscientious effort to ascertain and understand, render that service which in the same circumstances I would apply to myself, which is basically saying, let me get myself into your shoes mentally. Let me understand your situation, but let me put my education, my knowledge, my thinking, my products and everything to work for you to make you better on your behalf. The IARFC, which I'm a prominent member of, I've served on a number of committees with them, their code of ethics. I will put my client's interest above my own at all times within the scope of my abilities. And at the bottom, I will give my clients the same service I would provide to myself in the same circumstances. The $1 Million Roundtable, now they don't call it a code of ethics, they call it terms and conditions. But number 1, always place the best interest of their clients above their own direct or indirect interests. Now, what's the consequence? If they are found in violation of those things, the main thing that happens with these organizations is their designations are revoked or their membership is revoked, things like that, if they're found guilty. They don't have the power to arrest. They don't have the power to convict. All they can do is say, you can't be a member with us anymore. Some people don't necessarily like that. They want criminal things. But if you're really a criminal, as we talked about at the beginning of the program here, if you're a criminal, you're going to be prosecuted. You're going to serve jail time, all that, because that's criminal activity, not an oversight, not a difference of the scope of advice. I got one more thing to share because this one's one of my favorite articles. Where is it? Oh, I have to stop screen and then present my other screen. Okay. I remember how to do this. Okay. This is an article that was in 2015, and this is called The Evolution of Lee Munson. It was in Wealth Management Magazine. And this guy, I just love it. And I'm connected with him on LinkedIn, but he doesn't post much. And he used to be, not only was he fee only, he was a member of NAPFA, the National Association of Personal Financial Advisors. And they are fee only. I don't even know if they're assets under management fee only. I think sometimes just you pay out of pocket for a consultation, which to me also means these people do not have any incentive to learn about life insurance and annuities. Because they can't get paid on it. It's considered a conflict of interest to get any kind of compensation on it. Therefore, it's automatically evil. And so that's what he said. He said, I was a NAPFA cult member. If it wasn't fee only, it was evil. But he found his new firm. He wasn't really able to offer the kind of holistic financial plan that he intended. He realized that I really wasn't hitting the mark with people. I wasn't really able to do anything other than manage stock and bond portfolios. It just wasn't satisfying to me. It certainly wasn't satisfying to a lot of our clients. So offering insurance, he felt, was a big way to close that gap. He partnered with Tracy Ann Miller, a chartered life underwriter, hint, hint, who specializes in insurance consulting and financial planning. So after denouncing the commission model for years, he did an about-face, ditching the fee-only mantra in order to make money on the insurance side. Insurance now accounts for about 10% of his business. The fee-only thing is a real disservice, Munson says. He compares it to Alcoholics Anonymous. Financial planners are basically saying they cannot be trusted to engage with any financial product that pays a commission. I have a problem and I can't control myself. So I joined this cult called NAPFA, and I have to tell everybody I'm not allowed to drive because I'll get drunk and crash. And that might be a slight exaggeration, but the fact is that's the fact. There's some people that are just so entrenched in this that I'm fee only. I'm only on your side because if I get a commission, I'm going to get addicted to it. I'm going to only want to hit my sales quotas and earn more and more money. And come on, where's the financial objectivity? If you can't trust yourself, why should the client trust you? I have a major problem with that. So to me, if we have a lot of financial professionals that will watch this, either they're watching live in real time or they're going to watch it later. I promote having the most flexibility in your business operations. I prefer, if you're going to have securities and insurance, be fee-based, not fee only. Fee-based means you have the most flexibility to do whatever you want, but you can also do assets under management. You can also offer annuities and everything. Of course, you got to run everything by your RIA's compliance and everything else. Not saying ever to skirt the rules, but if you want the most flexibility to offer almost everything, that's the way I would do it. I would avoid fee only because I want my professional judgment to serve the client, not some arbitrary standard saying because you're getting paid this, you can't offer it. No, I'm going to use my professional job. I'm going to serve the client the best way I know how. Don't handcuff me. And in a way, heaven help them for anybody that does try to handcuff me, because I'm going to be the one to bring the standard to the client. That's what I want to do. And one last part here, because it is impossible to eliminate conflicts of interest. It is just not possible. So if you're a fee-only planner, what is your conflict of interest? Let's stack your calendar with as many consultations as possible so you can maximize your earnings. If you are doing by the project, the desires to minimize the thinking of your planning so that you can just churn out these plans, so that you can be as the most efficient as possible. If you're charging a percentage of assets under management, you want to have a little desire from clients to, we talked about this, convert from fully taxable investments to tax-free investments, and unless they can pay the taxes out of their pocket as opposed to out of their investment, because otherwise that impacts your own cash flow. For commission-based products, yes, there is a conflict of interest. They could be considered a big one. The tendency is to structure a case to maximize our own commissions, but is that desire done in an ethical manner? And that's a little bit harder to judge. And I don't know how to advise the public on how to look for it, other than ask the agent and advisor how to prove it. Prove how I'm going to be better off. Put it in writing somehow. And I don't mean an illustration. An illustration, I was on the thing yesterday, the guy called illustrations are illusions. You never know all that stuff. But show me, what is it that I can reasonably expect? out of this contract, out of this life insurance, but whatever it is. And that's one of the things that I happen to like about the way we work. I work with contracts that on a basis of what they will do, not necessarily on what they might do. Okay, that was a rant and a half. Any thoughts, guys?
No, I mean, I think you're exactly right with what you said about, being a standard. I mean, for us as, involved in what we're involved in and what we feel like is in someone's best interest. I think, if the majority of the advisors and the fiduciaries of the world would just take a deep breath and really focus on putting their client first with everything that they do, taking the fee out of it, taking the sale out of it. That's why we, our communication within our group is centered around that very thing. It's about communication. It's about educating your client. Let them make that informed decision after they've been, given all the information. It would end a lot of the back and forth that's going on, from the regulators on both sides, I think, and hopefully that, there's the majority of those advisors out there who are giving that fee-based advice or that fee-only advice, whichever lane they play the most in, that, they're doing it to a high standard that's both in the best interest of their client and themselves as well. So, it's hard to draw a fine line with, this is the way it should be. And it's because we've let it go so far. I think that, we've kind of crossed that threshold that, we may not be able to recover from, but at the same time, money and meetings are still somewhat of a face-to-face engagement with a human being that you should have their best interest at mind. And that's just kind of the way that I've always done things. That's the way I'll, continue to do things. They're going to come first.
Yeah, absolutely. And oh, I hate it when that happens. Yeah, I had a thought it was going to be so good. Okay, no, here's it. See, the thing is about our lobbyists on both sides. They keep using the term best interest, but they don't really clarify what the problem is. And this is why if the Department of Labor best interest rule let's call it that, if their version passes, it's against receiving insurance commissions unless the client authorizes it. And so there's an inherent bias that's being there. And yet no one talks about it that way. They say, well, the client's going to have less choice. And that's part of it. The question was supposed to be the other day, which was, do you think that the costs of everything going to go up? I think it might increase a little bit of the agent's E&O because there might be a little bit higher cost of the possibility that a complaint may happen. That's a possibility. But really, the companies, only want the companies to do is manufacture good products. I want the companies to compete for the agent's attention and the agent's business. And this is why the annuity companies, their job is to cater to the agents. The agents will sell what they like to the client. And most of them are about the same. There's going to be some contractual differences. But here's the thing. The company has to make money, the agent has to make money, and the client has to be better off. All three make up the three-legged stool. And if one is out of whack compared to the other, we're going to go to other companies that are going to be a little bit more in line. I want the company to win, but the company's going to be the last to win. I want the client to win first. I want to be financially compensated well. And then the company is going to recap everything over time, as long as I did my job well. But yeah, it's just the lobbyists for either side, they don't communicate what the real issue is, which is why I brought it up as a duty of loyalty regarding where the compensation is coming from. Because if the compensation is coming from any source other than the client, the fee-only people can't do it. And they're automatically close themselves up. Can't touch that. Why would I work with an advisor that voluntarily chooses to not do certain things that could be in my best interest? I have a problem with that. I'm going through my notes. I went through a whole lot here, and I think I covered everything. So I want to get to Alonzo. Go ahead, Mike.
No, yeah, I was just going to say, I think it was interesting when you showed that last article that you were showing. I did a little extracurricular reading after you finished on that page, and it seemed to me like it was, I can only read a part of it, and maybe I'm wrong as to what it's going to say going forward, but it seemed to me like because he couldn't collect any sort of a commission with his designation, that the board or whatever that thing is that he was with was recommending that he start charging a fee on insurance products that he sells. Now, here's the interesting thing, going back to your other point. That just proves that no matter if you buy the policy straight from the company or from an agent, it's going to be the exact same cost. Because if they can imagine that, you can be charged a fee, and the company is going to not only keep the commission, but maybe he gets a referral fee or a recommendation fee or a fee for whatever kind of a fee, for doing his work, and another agent writes it. So now not only are they being charged a commission on the insurance, but then they're paying this guy a fee on top of it. So, I mean, that was brilliant. That proved right there that the commission that an insurance agent makes is not costing you, the client, anything extra.
Yeah, it opens our eyes when we start to peel back the layers of some of this propaganda. We start to see what the real truth is. And
I just thought that was really, really fascinating. That was their solution, was to charge a fee.
Yeah. Well, by the way, I have a fee schedule, and my fee schedule is based on analysis work, not necessarily based on my time. If I'm going to be doing business succession planning, if I'm going to be doing the business valuation, I'm going to be charged for doing that analysis. I'm going to charge the client for that. I'm going to charge the client for time to put together analysis and recommendations. But at the end of that engagement will be a plan assurance or a plan satisfaction guarantee, not guarantee, plan acceptance document that the client will sign that's saying, I'm happy with what you've prepared for me. That ends the fiduciary engagement there, and the client is free to engage with any professional they want to say, can you implement these life insurance policies? Now, I'm pretty sure that 99.999% of the time they're going to implement them with me, because it won't take much for me to do, because I've already got all the information, no problem. But they can choose to implement them with anybody else they happen to choose. I don't see why they would, but they could. And so there's a defining line of time between here's the fiduciary engagement, here's the end of that. Now I'm going to put that into play for you. So Alonzo asked a good question. With suitability, why are there so many term only or IUL only guys who aren't being reported? Do you think we as ethical advisors have a duty to report them? And my opinion is that the insurance industry is still a business. It's an industry. It is not necessarily a profession. And so these insurance companies and field organizations, we all know who they are, and these are primarily recruiting organizations that's coming to my mind. Their job is to sell policies, and it becomes a money-making thing. I really hope that they would put their clients' best interests forward. I really hope that they're representing their products properly and such. But who do you report them to? Because they don't do more things? That's a business decision. Just as it's a business decision for me, I have insurance-only licensing currently. I could eventually be, either form my own RIA or join someone else's RIA. I'll never get with a broker-dealer. Anybody's a fan of that, sorry. I am not going to do that, because if I do that, I'd have to get all of this stuff that we talked about approved by them before I talk about it and make it public, and I'm not doing that. So,
I think this is a brilliant question, right? I mean, who says that it's in the best interest of the client to buy term only, like some people promote? Why is that in the best interest of the client? Can you prove it? I don't think you can. And how is an IUL in the best interest of the client? I can prove 99% of the time that it's probably not in the best interest of the client, but there may be situations where it is. So, I mean, if you're going to say, carte blanche, buy term, invest the rest, well, okay, maybe that isn't in the best interest of this particular client, but some companies sure seem to think it is. So I think this is a brilliant question. I love this. This you could really go down a rabbit hole with this one.
Oh yeah, we can, because some of it will be the race to the bottom of I'm in your best interest because I charge the least commission and I charge the least fees. And quite frankly, they think that's the ethical, moral way. No. And in fact, in my speech I'm giving to a NAFA organization here next week, one of the things I want every insurance agent to do is show people the maximum possible. You should be showing the maximum possible policy that people can have, and why. Why will the insurance industry let you buy that much policy? And it's not because we want your premiums. It's because of the protection components to it. Why can we do the maximum amount using the tax code? I want to show what the maximum possible. Can you usually do it? Maybe not. But I want to show people what's possible and then you adjust from there. And let people know why they can do it that way. And Alonzo added another one. I know guys charge you only 1.4 AUM annually. Immaterial. It could be 0.5. I know I think his pricing was 0.5, 50 basis points as far as his fee. But I was with an RA that charged up to 2.95%, depending on the allocation. So it depends on what you're managing towards and why and such like that. So anyway, we are pretty good. I was expecting to take more time, but I think we covered almost everything that was on my list that I wanted to actually get discussed. Fiduciary, especially fee-only fiduciary, has become more of a hoax. It is deceptive. It is not necessarily in the client's best interest because it restricts the advisor's ability to serve for an outcome as opposed to actually just serving based on their compensation. And by the way, one of the things, and if you haven't met with us, we can generally show you how you can retire using half the money that the fiduciaries say you need to have for the same cash flow. They can't do that. We can, but they can't do it because they're not allowed to, and they're not allowed to because of compensation rules, right? So because they can't, we can't. This is where we win. So we're going to leave you with that tease on that. I want to thank everybody for listening in and joining in. And if you're listening to this later on, thank you for listening and subscribing. We'll catch you all next time. It will not be next week, but it'll be whenever our next one is. So we'll catch you next. Thanks.
Well, there you have it, ladies and gentlemen. The Financial Advocacy Podcast just broke down to you some of the things of fiduciaries. So it's a heavily regulated industry. And, at the end of the day, a fiduciary is a term that us in the financial services industry are able to throw around at you, the general public. And, you may feel, oh, well, this guy's a fiduciary. I actually was at a bank and I was withdrawing some money from my savings account because I needed gas for my Benz. And then, me and this guy who was at the bank depositing or withdrawing, whatever he was doing, started asking me some questions. I gave him my business card inside of the bank. And if you're a financial professional, trust me, go to the bank and prospect. It's a great place to prospect. You can even go to the tellers and ask them if they know anything about BOLI, and they'll have no clue. And I'm talking about the private client guy. Oh, I kind of just gave away the bank, right? Well, no, all banks have private clients sections. But I'm talking about the private client guys at the banks. Right? And these are the guys who are dealing with the high net worth individuals at the bank. Yet they don't know about BOLI. So the guy asked me, well, are you a fiduciary? I said, yes. I said, but I'm going to be honest with you. Being a fiduciary doesn't really mean anything. Oh, yes, it does. Sir, I am a fiduciary. I'm trying to tell you it doesn't particularly mean anything. To you, the public, you might think it means something, but I'll tell you exactly what a fiduciary means. I'll equate it to food products. If you're looking at a food product and it says fat-free or diet, that doesn't absolutely mean anything. Okay, so they don't use real sugar. They use artificial sweetener like aspartame, which is going to cause you cancer. Or not going to, but it's shown that and proven that things like aspartame have a large impact on people getting cancer, right? Things like, oh, I use margarine instead of butter because it's less fat. Yeah, but there's more caloric intake, and calories are what add to you getting fat, right? There's more sodium, and sodium is something that adds to clogging your arteries and giving you cardiovascular disease, right? But it's fat free, so that it's just a term tossed around, to make Diet Coke, fat free butter. Just use the real thing, right? Now, again, as a fiduciary, we do try to maintain ethical standards, but just like my guys said, and let me go ahead and turn on the camera. I'm hearing a wife beater right now because, but just like my guys said, I'm in a wife beater because I was doing some physical labor, which I generally don't do, but my grandmother's apartment caught on fire, so I had to help her move stuff. So I will be getting ready to go shortly because of that. But the reality is that a fiduciary, again, there's basically two things that a fiduciary has to do. One, like Dave said, we have to disclose to you. So give me 1 second. I'm going to show you something in terms of disclosure. Well, you know what? I won't even do all that right now. I'm not going to get up. But for example, I got this cup from T-Mobile. Let's say this T-Mobile cup was from a financial company. We'll say, I don't know, what's a financial services firm out there? Let's say MetLife. Say MetLife gave me, as a broker, this cup. The reason they're giving me this cup, like you saw David say, hey, I got to disclose that, LPL Financial gave me this mug. Why does he have to do that? That's our fiduciary responsibility. We have to disclose to you, hey, how much do you get paid? And if what you're recommending is a conflict of interest. So how do we do that? Well, one way that's done is you, as the customer or the consumer or the client, need to kind of be a fiduciary of your own and look out for your own best interest. How do you do that? By asking questions, right? If a buy term invest the rest guy, which there's nothing wrong, what's popping TWP? Nothing wrong with buying term and investing the rest. I sell a boatload of term life insurance. I actually want to start going back to my old book of business and selling them an additional term life insurance policy, because as I grow in my career, I'm realizing, and I've said this for years, the wealthy insure one life at least 7 times, right? So buy term, invest the rest doesn't mean buy a term policy and don't buy any permanent life insurance. That's not what that means. I've had clients who have seen, hey, what's going on, Financial Advocacy Podcast, Dave? Yes, thank you for the knowledge that you are giving. This man right here is a wealth of knowledge. Okay. I love the knowledge that he gives. I figured since it's almost an hour in runtime, I figured I'd just, blab on a little bit and throw my own take on there. But when you're looking at, these financial professionals, ask them questions, right? One of the things when they say buy term, invest the rest, that I am probably going to go on a certain guy on TikTok and say, hey, do you ever offer the clients a prospectus? Because most clients who are unsophisticated investors, which is 90% of America, 99% of America, right? At least 95% are unsophisticated investors. So you guys aren't going to know to ask for a prospectus, or even when you get a prospectus, you're not going to know what you're looking at. It's just like when you're getting all these Forex guys and these options traders who are, oh, look at the pips and dips and the daily averages. But they don't tell you that FINRA, the Financial Industry Regulatory Authority, since we're talking about fiduciary responsibilities, requires you to have a margin account before you can actually execute day trades. You can trade during the day in a cash account. The absolute truth is that you do not need a license to day trade. Okay, you don't need a license to trade options. You don't need a license to trade Forex. They're telling you the absolute truth. You can use a cash account to trade options. You can use a cash account to trade Forex. However, you can't execute pretty much more than 2 trades in a week. Why? Because, well, number one, FINRA considers anyone who executes 4 or more trades within a 5-day period a pattern day trader, which is a real day trader. The SEC has specific definition for a sophisticated or accredited investor for unregistered securities. Exactly. See, I told you this gentleman is a wealth of knowledge, and I appreciate it because as I mention things, I know I have someone here who understands the language that I'm speaking, because this language, sometimes when I'm talking to clients, you can just see their eyes glaze over when I'm spewing off stuff, right? So it's always good. I try to put as much stuff as possible as I can into layman's terms, but always ask for a prospectus, right? Also, if someone is selling you an insurance product, I don't care if it's term life, I don't care if it's whole life, I don't care if it's indexed universal life or traditional universal life or variable universal life for that matter. Ask, hey, can you give me your company's annual report? Right? Another thing, I know this is law in New York, and I am my resident state, even though I'm physically here in Connecticut, my resident license is in New York. New York, California, and Florida are the 3 most highly regulated states in the country, right? So in New York, they have their own law called Regulation 187. You can actually face, I believe you may be able to face criminal penalties with Regulation 187. Now, we've had a class action lawsuit trying to get it repealed. The insurance commissioner in New York has appealed that repeal of Regulation 187. So because she's appealed the repeal of it, it's still intact. So even if they're writing a simple final expense life insurance, they have to make sure that this product is suitable for you. New York also has a completely separate suitability department. So once you apply for that insurance, that annuity, that mutual fund, whatever it may be, you have to, California has SB 263 that made 187 look like a picnic. Yeah, California is something else. I'll tell you. You guys have to put your license number on illustrations. I have a couple of agents who are in California. I'm like, wow, you have to put your. I mean, I don't see anything wrong with having to put your license number on anything. They make realtors do it, right? So, I don't mind putting my God, what is that number? I can't think of the number. Not my license number. My the number when you're licensed in multiple states. Let me go to NIPR and I'll tell you what it is. My NPN, your national producer number. That's what it is. So I love, your NPN. I'd love to put my NPN up there. To be honest, David, I think Regulation BI or best interest, because you can face, I believe, criminal penalties, and Regulation BI hasn't gone all over the country, but these are things that are there for consumer protection. Ask the agent again, hey, how do you get paid? What percentage do you get? Right? You'll notice now, a lot of agents will say 50% is not what's called street level commission. So street level meaning you're fresh out of college, it's your first time selling financial services, specifically on the life insurance side of things. Property and casualty is a different story. They get like 10 to 16% commission. Property and casualty agents they just get to keep their lights on. Life insurance will make you rich. But you can ask them, what percentage of commission are you getting off of this? Because what a lot of especially term only agents will do is, oh, well, these whole life guys, and I'm not a whole life guy. I'm an IUL guy, right? But I am a licensed guy. So I don't care if you buy term, whole life, IUL, you know why? Because I can sell them all. So at the end of the day, I know I can get a commission off of whatever product best fits you. I have clients who have come to me, hey, I want an IUL. Listen, looking at your situation, now that we've done fact finding, the IUL isn't in your best interest, right? The IUL is an expensive product, right? People will tell you, oh, infinite banking, you can start it with, even people like Doug Andrews, who has the laser fund. You can start an infinite banking with $300. That's generally going to be with a traditional whole life, not with an IUL, because of the guarantees. But again, I prefer IULs due to the flexibility of the product. Again, now I'm nerding out and I'm kind of talking product specific things, but ask that agent, hey, what commission percentage do you get off of this? Because some agents will be street level 50%. If you're with certain 3-letter organizations that focus heavily on recruiting, the reason they focus so heavily on recruiting is because they get started at a 25% commission. And until they have a certain amount of agents under them, they can't go up to even 50% or 75%. There are other organizations that, at least one of the companies that focuses on recruiting, and shout out to Dave for this, is actually its own insurance company. They actually write policies. They actually do their own underwriting, and they actually do pay claims. As much as you'll hear advisors like myself who hate that company, and we talk all this garbage about that company, which technically we shouldn't be talking garbage about that company, because technically that's going against our ethical standards. You're not supposed to what we would call twist, which is, make someone have a bad opinion of someone, right? It's just like, in high school, hey, that guy over there, he's a creep, he's corny, and you've never met him. And now, you're thinking this guy is a weirdo. And then you guys are in, I don't know, history class together, and he's the coolest dude on earth. Let's see. It says company culture is different than the company's ability to pay claims. Yes. That is a very true aspect, which the ability to pay claims is why you want to ask for a company's annual report. If you ask an agent, hey, can I have your company's annual report? Now, they might not be able to give it to you right now, right? They might have to say, hey, I got to go online and pull it up, and then I'll email it to you. But if they're like, what's the annual report? Run, right? If they're trying to, have you invest in a mutual fund, buy term and invest the rest in a mutual fund, can I see the prospectus? The what? Run, right? Just like if somebody says, hey, I trade Forex or I do day trading. Hey, do you have a Series 3? I don't drive BMWs. Run, right? These are things that you should legitimately be asking any financial professional, right? Hey, what commission percentage do you get? So a lot of, and again, for this is for life insurance. So with that company that, again, it does pay its claims, it does, it does write its own insurance, it does underwrite. There are others who are what we call IMOs, or independent marketing organizations, and they have the same culture. Recruit, recruit, recruit. There's a few 3-letter ones that I can think of, and it's not ADH Wealth Solutions, right? But and then that also muddies the water, because you have IMOs like mine that are small boutique firms that also have relationships with a multitude of carriers, just like some of these ginormous IMOs that you go to the meetings and they're the same rah, rah, rah as that buy term invest the rest company, right? But they get up to 135% commission, right? So you need to ask, hey, what do you get paid? What percentage do you get paid on this? Because if you say, how do you get paid? We're salespeople. We're very savvy. I'll say, well, Mr. Hall, I get paid a percentage of what you pay in the year for this life insurance policy. Now, that doesn't come from you. That comes from the insurance company, right? And what people have to understand is life insurance companies would love for most people to just buy term insurance, right? You would think, well, why would they want them to only buy term insurance? I mean, if somebody dies, then, they're on the hook for these large sums of money. Yes, but studies have shown that 99% of term policies never pay out due to lapse. Now he says, but is that commission a material fact that should be considered when buying a policy or not? I don't think it's a material fact that should be the absolute determining factor. However, that can make a huge difference for example, when IUL guys structure a policy. Prime example, you got, I was actually watching Life 180 with Chris, and he was explaining that one of the carriers that's Moo was, they told a lot of their agents to structure the IUL based on target premium. So if you structure that client's policy based on target premium means that's what it costs. That's the actual cost of insurance. Well, that pays me a huge check, but that doesn't do you a benefit. With most of my clients, I take a substantial haircut in my pay, and often I'll let them know that. And I use that as kind of a marketing tactic, because when clients are like, wait, why are you taking money out of your mouth? Because, well, multifold. One, when I show you the policy and I design it for what our conversation is, and this is another reason why it's dangerous to go online and talk to any other advisor, right? Hey, I have this here policy. Can you review it for me? Well, now they're looking at the policy without having done a fact-finding session, right? So they don't know that conversation that you and that other advisor had, right? And I actually kind of considered this from another advisor that I had brought onto my show. And David, I'd like to bring you on one night, 8:30 p.m. Eastern. I usually do a show called Friday Night Financials. I don't know if I'll do one tonight. I kind of had it scheduled with a second part for what I was doing last week with my brother-in-law. And he works in luxury real estate leasing. And we were talking about, people getting paid a straight commission versus a base versus commission, like a draw or a base with commission, or, a salary. I'm a person who, I like 100% commission. Not that I get paid 100% of what you pay for the year, but my check depends on nothing but commission. He says target premium should mean that the premium would help the contract mature at age 100, 120, but overfunding is the right way to go, particularly to help offset the cost of insurance during down years. So that's the thing. See, I have a different philosophy there, David. I believe in limited pay. I don't think and so that's why I appreciate the term people. But again, life insurance companies would love for most people to just buy term, because again, a study from Penn State University shows that 99% of term policies don't pay out. And this is not because people outlive their term. This is because they lapse their term, right? So you've paid, even if it's $50 a month for 10 years, and then boom, so $600 a year, that's $6,000 the company got for no apparent reason, right? After paying commissions and so on and so forth. So maybe $5,000. Commission only is the best for the client to maximize returns in their policy. I do think so, but I am, you're actually, you brought up a good point on your episode today, because I am considering going to a company that I got some information that they are, there's a big money management firm by the name of LPL Financial that is taking over everyone in the industry. I know they're with like M&T Bank. LPL is a giant, right? Now they're not as big as, maybe BlackRock or something like PIMCO, but they're pretty large themselves. Give me 1 second. I have a text message here. So, those things are very, very advantageous to the companies, but I'm considering going with this company. They're one of the I think they're second in having the most agents qualify for court and top of the table with MDRT. Number one is NYL. And I'm sure, David, who number two is in terms of having the most agents or financial advisors and professionals who qualify for MDRT. MDRT, ladies and gentlemen, is something called the $1 Million Round Table. And they have an AUM model, which, I'm kind of liking. Also, I have an uncle who for the last 41 years he started with I think he started with Connecticut Mutual, which is Mass Mutual, 40 years ago. And I'm 40 years old myself. But ask the agent, hey, what percentage of commission do you get? Yes, he just put it here in the chat, ladies and gentlemen. Please click that that link. He says that link shows the top rankings of companies in the US and around the world. Yeah. So, you can also do your own research, and hey, but you ask for the annual report. Ask that agent, hey, what percentage do you get? Because again, that percentage can have an effect on how that agent is. Number 6. Okay, well, they're getting up there in broker dealers. They're really getting, when this move happens in the next few months, Dave. In fact, I am going to DM you because I don't want to say it publicly. Who LPL has partnered with. Give me 1 second. Let me. So they're gonna get a few more billion of assets under management there, which is amazing. So Dave, I just shot you a DM on Facebook, so you can see who those guys are taking over. But like I said, ask about those couple of things. Where's my speaker, by the way? Because I got to get my music going for you guys, right? But ask, hey, can I have the annual report of your company? And by the way, what commission percentage do you get? Right? Because yeah, not a bad match at all. And I was considering moving myself over there, but then at the firm there here in Connecticut that I'm looking at partnering with, who is obviously that carrier. Like I said, they're not heavy on insurance, and my commission percentage would go way down. I'm at 90%. Excuse me. And with them, my commission percentage would be cut in half. They do 45% with a 19% bonus. Which, okay, so that'll get me to what, 60%, but that's still 30% less than I make now. And I actually already write through them as a broker. Now, I wouldn't have, access to everything that they're doing, especially in terms of they're really an AUM model. That's where I was telling you with the 1.4% AUM. And that, I'm considering that because, I may want to do that. But as you mentioned, then in order for me to do stuff like this, I'd have to run it through them, and I'd probably have to erase my YouTube. And, I am like Ted Pitt, right, from Morgan Stanley. I am a foul-mouthed advisor, right? I curse, I spit, I listen to gangster rap, I smoke, all that good stuff. I listen to rock too. Hail to the king. But it 6 and 1/2 dozen in the other. But I also am considering, going to the AUM because I want to break further into the HNW, high net worth and ultra high net worth market. And I'm thinking of going back to the Barclays Center where I initially started, and going back after the NBA draft, getting a lot of the basketball players to let me be their advisor. When I started, unfortunately, especially them being a lot of young black men, a lot of black people are brand loyalists, or they want to know that they know of the brand, which is so funny. Like, I'll say, hey, I'm with this company, and then a lot of Americans don't even know that a vast amount of their money in their 401k is with a company called PIMCO, one of the largest mutual funds in the world. Used to be the largest, about a decade ago, I think it was the largest mutual fund in the world. But ever since then, that's BlackRock. And it's just insane, right? Just like a lot of people, we talk about generational wealth. and generational wealth is made through families. I'm going to get back to my point shortly, but generational wealth is made through families. And let's look at one family that everybody's familiar with, right? JP Morgan of Chase Bank, or JP Morgan Chase Bank. Well, he happens to be the grandfather of Henry Sturgis Morgan, who is the founder of Morgan Stanley, Dean Witter, Smith Barney. Just bought your mother's house because Morgan Stanley is buying everyone as well, right? They just bought E-Trade. Charles Schwab bought TD Ameritrade, right? Back in 2019, they didn't start changing the account numbers until October 2023. So this is stuff that, unless you're behind the scenes or you're in this field, you're not going to know. And then if you're not obsessive like myself and David, there's a lot of agents who don't know this stuff, right? So again, I want to go back to your comment about the commission, David, where, but is that commission a material fact that should be considered when buying a policy or not? I understand your stance of not believing that it is, but again, I believe that it is, because if I am an agent who only gets 25%, I'm going to want you to get the smallest life insurance policy possible so that I can push all your money over here into this mutual fund, right? And get paid AUM. The other difficulty is that with life insurance, you have to qualify for it. You don't just go apply for life insurance and get it, right? Prime example, I don't have life insurance, and I've been selling it since the age of 27. Why do I not have life insurance? I am uninsurable. I will fill out the application, work for the company, apply, and they'll be like, yeah, we're not giving you any insurance, bro. Sorry. You're healthy. No. So that's another reason why I'm so passionate about it. But I do believe everybody should have a term policy if you are a breadwinner, right? Or if you have people who depend on your income. That is one of the easier ways to get generational wealth. If you go to Google and ask how long a generation is, Google will tell you between 20 and 30 years. Let's use the lower, 20 years. If you go to Google and ask what's the average income of an American, anywhere between $50,000 and $60,000. Yet let's use 60,000. 60,000 times 20 is $1.2 million. So your average American, just to leave one generation of just making it, because $60,000 a year is not wealth, needs a $1.2 million death benefit. IUL does have unique properties where the structure of premium needs to be disclosed to show the policy will last and fulfill what you promised it should. Exactly. Right. Which is why a lot of these IUL only guys are very, very dangerous, because they're running around saying, hey, the IUL is a Swiss Army knife. It can be. But again, that really goes back to the conversation that you've had with your financial professional. And guys, I hope you guys are looking at these comments that the Financial Advocacy Podcast is putting up here, right? Like I said, elite financial professionals, we don't compete, we collaborate, right? Why? Because that's going to help you, the general public. If you don't do business with me, but you do business with Dave, you're in great hands. If you don't do business with Dave, but you do business with me, you're in great hands. I can't say that about every advisor, but there's a lot of advisors that I can say that about, right? Because we have had these conversations behind the scenes. So term insurance is an absolute necessity for just about every American who earns an income, if you have someone dependent on that income, whether it be a spouse, a child, a disabled person, an elderly person, right? Or maybe you want to do it like a charitable, if you're a godparent, right? If you're a parent, and this is big in the Black community, oh, I'm going to make the rich uncle my godparent, my son's godparent. And you don't put at least a 20-year term life insurance policy on yourself and make that godparent the beneficiary, you're doing a disservice to your child. What you're doing is you're saying, hey, you can treat my kid like a redheaded stepchild if something happens to me and I die, because I'm not going to give you any money to take care of this child. But as a godparent, you're legally obligating yourself that if I am deemed incompetent or deceased, you'll step up and take care of that kid. Now, another thing is that life insurance guys, I don't care what type of life insurance it is, we kind of market terribly. What do I mean? Oh, what if something happens to you and you die? Oh, that's terrible. What if something happens and so dies? We sound like mobsters, right? It's really scary. Hey, that's a nice family. Be terrible if you died. Whoa. Hey, Donnie Brasco, chill. Right? But one thing that we don't talk about, which is what happens way more often than something happened and you dying, is what if something happens and you live? Death and dying insurance. Exactly. Right? So we also need to talk about what I call paycheck insurance. The industry calls it income protection, and you might know it as disability insurance. The reason I call it paycheck insurance is because the average American wants to know that their paycheck is protected. So, just like a car has 4 wheels, there's 4 products you absolutely need if you're earning an income, especially if you have someone other than yourself who's depending on that income. A very large term life insurance death benefit, right? So, again, like I said, I'm going to break this down like this. You'll get those term guys who are like, hey, give me 1 second. It's 2:30. I got to check if my mother is ready for what have you. She is not texting me yet. Okay. So a lot of guys will say, oh man, you got I'll use an IUL. You got a $200,000 IUL for $300 a month. I can get you $250,000 death benefit for $75 a month. Cool. But number one, did you purchase that IUL for a death benefit? What's going on, brother? Did you purchase that IUL for a death benefit, or did you purchase it for another reason? A lot of people may have purchased it for something that I posted on my TikTok, which is the rich man's Roth, right? As opposed to a backdoor Roth, right? But the reason you think, oh, well, let me get this $250,000 death benefit for $75 a month. Aisha, what's going on, ma'am? Do you have a wrench? You do not. I need to get you a wrench. Bear with me. Let me pull up my live. I didn't even expect to be on this long, but I'm going to stay on for a while because I'm passionate about this, right? And I find that it's very important that you guys are learning. Hold on. Did I give? Yeah, okay. I gave the Financial Advocacy Podcast a wrench. Actually, let me give you this. I'm going to take the wrench away, Dave, but I'm going to give it back because I need to make you a managing moderator. Okay, there we go. I am not monetized, Aisha. If you'd like, hold on. If you want to donate to the channel, it's much appreciated. I do appreciate it. Do not feel obligated. If I'd prefer, now I do charge a fee for my consults, but I'd prefer that you get a consult with me, right? So that you can actually get the specific advice, right? That is tailored to you. But again, I think every person, especially if you're a breadwinner, husband, wife, or either, should get. You guys see my water? You guys see my water cooler in the back? There's my water cooler. I got my car cleaning stuff on the table too. So I think you absolutely need a large death benefit with a term policy. Again, most people have not held $250,000 in their hand at one time, so it seems like it's a lot. But I just told you the average annual income is $60,000 a year. Generational wealth, one generation is 20 years. 60,000 times 20 is $1.2 million. So if you're going to get a term life insurance policy, you do need to spend a few $100 on it. And it needs to be, a 1 million, a 2 million, a 5 million. I tell you, if you want to create generational wealth, you get a $10 million death benefit. And when and in your will, you state, hey, when I pass this life insurance policy, if it's in a trust, okay, but needs to be placed into a high yield savings account. We are in a 0.5% interest rate market right now. I want info on putting a parent's home in a trust so upon death I can avoid taxes. So yeah, that info is not info you would get from a financial advisor. That info is something you would get from an attorney. Now, for many regular Americans, attorneys are very expensive. I actually have a buddy who does something called Legal Shield. If you like, shoot me an email. I'll put my email in the chat. And we can shoot me an email. We'll link up. I'll link you up with my buddy. There is a fee for the Legal Shield, but it's actually great to have an attorney on retainer. I actually am a customer myself. I think it's like $350 a year. At any time right now, I could call an attorney. Hey, I need some information about a trust. Now, I might not get the attorney right there. He might take a day or two to call me back. Or he might take a couple of hours to call me back, but I have an attorney on retainer. It's going to cost you substantially more. Usually billable hours on the phone with an attorney is $350 an hour. So there's also something called an ILIT, which is an irrevocable life insurance trust. I'll tell you somebody who sells that. Actually, his father sells them. He's maybe not for much longer if Patrick Mahomes keeps up this Super Bowl winning spree. But the GOAT, Tom Brady, his father, and he was in tears when he got drafted to the NFL because he was like, I was so happy, I don't have to be an insurance salesman. Because if you go to thomasbradyandassociates.com, you'll see that Thomas Brady Sr. is an insurance professional. And, that's kind of how that works. So, yeah, shoot me an email and, I'll link you up with my buddy and we'll put you in the Legal Shield. Like I said, I think it's like $350 a year. I just pay it for the year, so I can't remember how much it is. It might be $330, $350, something like that. But it's like $50 a month. And, you at the end of the day, or maybe it's like $40 a month, whatever it is. At the end of the day, you'll have the availability to actually speak to an attorney. An ILIT, irrevocable life insurance trust, is a great thing. But again, just like Dave said on the Financial Advocacy podcast, you cannot have these legal documents drafted by a financial advisor. You cannot take tax advice from a financial advisor. We're not tax professionals. I was on, what is his name now? It's Dennis Jerome's channel. Used to be The Amazing Hustler. He was on with a guy, and the guy was asking me some tax stuff. And, I don't know if you don't know this about taxes. I don't know if I would go to you as a financial advisor. I don't know that I would take you as a client. See, people have to realize that just because we're salespeople, we, just like a realtor, can choose to take you on as a client or not. It says, I delineate lifetime tax planning advice versus tax filing advice. Yes, that is very true. Tax planning advice is very different from tax filing advice, right? But he was asking me, like tax law and stuff. Well, what about, I don't even remember what the tax law he was asking. I was like, bro, I don't know. I'm not a tax guy. I'm not an accountant. I'm not, I'm not an attorney, so I can't give you legal advice, right? I'm not an accountant. I can't give you I can give you basic advice about how the products or services that I offer relate to taxes and may have tax benefits or tax detriments, because certain products do have tax detriments, right? Or, just the implications with taxes on those products. Prime example, a 401k is a tax deferred product. That's not me giving you tax advice. That's me telling you what the implications are for you on taxes on the 401k. If you want to know, hey, what's the tax rate going to be when I retire? Ask your CPA. Guess what he's going to say? I don't know. You know why? because he's not a legislator. The likelihood is he'll say they'll probably be higher than they are now, right? So a lot of people, feel a certain way. He says, yes, incidental tax advice surrounding a product, right? So that is not specific or direct tax advice. That's incidental tax advice. But so back to the products. Everyone needs a term life insurance policy, right? You'll also need a permanent life insurance policy, whether that be whole life or indexed universal life. I would not recommend for most people to get a traditional universal life. And that's one of the arguments that IUL guys like me and whole life guys have when we're talking about infinite banking, because Nelson Nash's book states explicitly that universal life shouldn't be used for infinite banking, but his book also came out prior to 1997, which means that it came out prior to indexed universal life. And universal life absolutely should not be used for almost anything, in my opinion, but there may be a situation where for you, the client, that product is in your best interest. I also generally stray people away from variable universal life insurance. I've noticed that most people don't have the risk tolerance for a variable universal life. Is a variable universal life basically an IUL on steroids when it comes to the gains? Absolutely. However, everything is at risk, and you really want to separate insurance, as insurance should be insurance and investments should be investments. I don't think you should commingle the two, right? Now, I am of the thought process that nobody should pay for life insurance for their whole life. So you would think, well, then you must be a term guy. No, absolutely not. However, permanent life insurance can be set up in something called limited pay. For example, State Farm has a great what's called 20 pay. So what that means is a whole life policy. It's going to cost you, for example, if you were to come to me and try to get a traditional whole life and say, it's $100 a month. Okay, cool. But if we were to change it and it'd be the same death benefit, let's say it's $1 million death benefit, arbitrary numbers, $1 million death benefit, $100 a month. Okay. But that means you're paying it for life. Or $1 million death benefit, it's going to be $450 a month. Well, why is it so much more? Because you're only paying it for 20 years. After the 20 years, you're done paying, but it's still growing cash value, and that policy is there for the rest of your life. Now, a reason why traditional whole life guys prefer traditional whole life over index universal life for infinite banking is you have dividends. Traditional whole life insurance pays dividends. A lot of agents are unaware that there's actually a dividend option that you can select while illustrating the product to your client. Most agents are just going to set it up so that it does what's called giving you reduced paid up, which in most situations, even though it sounds like, well, that's greedy, the life insurance company just gives itself your dividend and buys you more life insurance. It also helps increase your death benefit and increase your cash value accumulation. So at the end of the day, it's probably the most beneficial for most people as opposed to receiving a dividend, because then you got to pay taxes and all that other stuff. Or no, actually, I believe it's considered a rebate. David, can you help me on that? I think when you get paid back the dividend and you take it in cash, it's considered a refund of premiums. So I don't think you pay taxes on that. Again, I generally don't sell traditional whole life because I prefer index universal life, because there's flexibility in premium and flexibility in death benefit. So I have some clients who will say, hey, listen, like I had a client, he's paying about $2,000 a month on his IUL right now. And like I said, IULs are expensive. I'll tell most people, listen, if you're coming with, $300, $400, $500 a month, don't waste your time, because you're not going to get it. Well, depending on the age that you are. It says, yes, if a refund of unused premium until cost basis is recovered, then a cash out dividend is fully taxable. Okay. Yeah, see, that one confused me a little bit, but I know that there. So again, a lot of these things, like David prefers traditional whole life for infinite banking. I prefer IULs, but that's because I like the so the one more thing, and you need a spare tire, Sheed, is you have a term. Absolutely wonderful. Hopefully it's a substantially larger term than your whole life or your IUL. You have a whole life, do not get rid of your whole life. Okay? Because again, likely, and if I'm not mistaken, I know the company that you have your whole life and one of your IULs with, which is a great carrier. They are second in the country for paying dividends. They pay the second highest dividend in the country for life insurance companies. The highest paying dividend company in the country is, give me 1 second. Yes, mother. I can stop my YouTube right now. Do you need me to come?
Yeah. Can you meet me at the hotel?
I will.
See you in a few.
I'll be there in a few. All right, guys. So that was my mother. Like I said, my grandmother's apartment caught on fire. So everyone is being evacuated. She is now being relocated to a hotel for God knows how long. I'm also going to have to help her put in an insurance claim. So thank you, ladies and gentlemen, for watching. Thank you, David. I am going to go on TikTok and give you your flowers, just like I did JT the Pocket Watcher, as well as Bronze Flat Power, what's going on, as well as Michael Clark, the CFP. Thank you, Enya. And last night, I was trying to, you got to take care of grandma. I was trying to stay for the men's panel. Unfortunately, I couldn't because I had to go help mama, right? But you know, thanks to those brothers, as a I guess younger than them, black man in America who is a husband, it's actually refreshing because I see a lot of these dudes, what I call "where's my hug at" ass dudes, who are running around, you know, mad at women, this, that, and the third, and you know, passport bros and all that other nonsense. At any rate, ladies and gentlemen, it's your boy, the insurance junkie, your fiduciary fella, the all-star advisor, Alonzo Hall, your social media insurance broker, whapped and tapped on your head with another ADH wealth solution. Thank you for everybody who's liked, commented, subscribed, shared, shot a super chat, wanted to shoot a super chat, wished me and my mother great tidings and all that good stuff. With that being said, ladies and gentlemen, wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. And remember, folks, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.